You're listening to AI PRISM from Seoul Economic Daily.
A brutal 51.7% drop for the KORU ETF in 1 week, panic-level KOSPI readings above 70, and hashtag KOSPI daily volatility hitting 3.9%. A bizarre IPO market where half of new listings trade below offer, driven by 87% of retail money pouring into just 2 stocks, leaving Cosmo Robotics as a 374% outlier, a 6.28 trillion won, or $4.03 billion US dollar, futures ETF market facing mass rationalization, with 69% of products failing viability standards, and a regulatory tug-of-war over Samsung Securities' short-term note license overridden by the FSC in April, but eyeing a critical July resolution. It's Monday, June 8th. Here's what the numbers are telling us about Korean markets right now.
Yeah, when the sheer fear pricing we're seeing is just wild right now. Take KORU, the Direction 3X leverage Korea ETF listed over in New York.
Exactly, and it just collapsed. I mean, it went from $1,264 US dollars down to 610 in literally a single week.
Yeah, and then you pair that with the KOSPI, so that's the Korea Volatility Index based on hashtag KOSPI 200 options, and that's running above 70 right now, which signals just extreme uncertainty.
I mean, for anyone tracking standard metrics, a KOSPI over 70 is practically blinding. And, hashtag KOSPI intraday volatility is now averaging around 3.9% a day.
It's massive.
But what really fascinates me isn't just the panic, it's where the money is hiding. It's basically a black hole. Individual investors poured 63 trillion won, so that's 40 billion US dollars, into literally just Samsung Electronics and SK Hynix.
Which is, what, 87% of all retail hashtag KOSPI net buying?
Right. It's like everyone showed up to a massive buffet and only ate the potatoes. So does that mean the broader IPO market is just structurally starved of capital?
Oh, absolutely. It's a severe structural capital allocation problem. Those two semiconductor giants possess so much market mass right now that their gravity is just ripping capital away from perfectly healthy IPOs. I mean, half of all new listings are currently trading below their offering price.
Unless you're Cosmo Robotics, right? Because they're trading 374% above their offer course.
Exactly. They're the rare AI outlier. Basically, if you aren't a direct AI or robotics play with near-term revenue, you are starved of capital.
So how does this pressure finally break? Like, what are the catalysts you're watching this week?
Well, there are 3 main ones. First, you have the June 10 US CPI data, which is going to dictate the discount rate. Second, Oracle's earnings.
Because they act as the primary gauge for enterprise AI CapEx, right?
Exactly. And finally, the June 11 Mackie.
Right, Mackie being the Korean term for the quarterly futures and options expiration.
Yep. And even if the macro data is benign, the Mackie will amplify this underlying volatility.
Got it. And, this massive capital concentration in major tech names is forcing a structural rationalization down the line in passive vehicles, too.
Oh, definitely. The ETF market is completely bifurcating.
Yeah, looking at this 6.28 trillion won or $4.03 billion US dollar futures ETF market, 69% of these products hold under 50 billion won, which is roughly 32 million US dollars.
Yeah, they're falling way below viability standards.
Why are they suddenly so unviable, though?
They are just getting bled dry by rollover costs. When you run a futures ETF, you aren't holding the actual asset, you hold contracts that expire.
Right.
So think of rollover costs like a mandatory subscription you have to keep renewing at a higher premium every single month just to keep your position open. In a high volatility environment, that drag just destroys your returns.
Which makes low-cost physical spot ETFs look incredibly attractive by comparison.
Exactly, and that triggers the capital flight. Traders are strictly migrating to physical ETFs or leverage products or niche areas like silver ETFs.
And the drain is so severe, it actually forced 2 futures ETF delistings this month alone.
That's a huge bottleneck.
Wait, I need to push back on something here. I understand why retail money is flowing into AI and why ETF traders are fleeing rollover costs. But if capital is locked up in tech giants and silver ETFs, where does that leave early-stage startups?
Well, they usually rely on venture lending.
Right. So how does a regulatory delay on Samsung Securities' short-term notes matter to this broader capital drought? Isn't there alternative funding?
Not really, because traditional bank credit is heavily tightening, making these alternative funding lifelines absolutely critical. Major brokerages issue balhinjio-eum. Those are short-term money market notes, specifically to raise capital for venture lending. Samsung Securities was positioned to open a massive new channel for this.
But the regulators stepped in.
Yeah, there's a procedural deadlock. The Securities and Futures Commission, the SFC, conditionally approved the license back in April to help supply that desperately needed venture capital. But then the Financial Services Commission halted it over a pending disciplinary review.
Wow. So if you're a startup without the letters A and I in your name, you're essentially just watching the clock, hoping that penalty gets finalized so the capital can flow again.
That is the reality. If the penalty drops this month, Samsung Securities could secure that license in July. Until then, you really have to stop looking at the broad index. In a market warped by this kind of centralized gravity, your edge comes from tracking exactly where the remaining capital is being forced to flow.
That's today's AI PRISM, Markets Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a WAN-IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.